Most people think getting a loan should be easy. Walk into a bank, fill a form, get approved. But for millions of people, that process doesn't work. No collateral, no credit history, no access. And because of that, opportunities are lost every single day. Businesses don't grow. Emergencies go unresolved. Ideas never get funded. So the real question is, how did Carbon build and fund a digital lending platform and market where traditional banks struggled? Because inside that journey are powerful lessons every founder needs to understand, especially if you're building in emerging markets. In this video, we're going to break down how Carbon started, how they funded their operations, how they scaled, and what made their model work. Before we go further, if you enjoy content about startups, tech, and building real income, take a moment to subscribe to the channel and like this video. And make sure you stay until the end, because toward the end of this video, I'm going to share something extremely important that most founders overlook. And it could completely change how you approach building your startup. Now let's get into it. The story of Carbon starts with a very clear problem: access to credit. Traditional banks were not designed for everyone. Their systems required documentation, formal income records, collateral, and for many people, that was a barrier. Now here is the first lesson. When systems exclude people, startups can create inclusion. Carbon saw this gap and decided to build differently. Now let's move to the next stage. The idea. Carbon wanted to provide quick, accessible loans through mobile devices. No long queues, no paperwork, no unnecessary delays, just fast access to money. Now here is something important. They were not just digitizing loans. They were redesigning the experience. Now let's move to building. The model. Carbon used technology to assess users. Instead of traditional credit scoring, they use alternative data, user behavior, phone activity, transaction patterns. This allowed them to make lending decisions quickly. Now here is the key point. Speed became their advantage. Now, let's move to something critical. Funding the loans. This is where many people get confused. How does a lending startup actually operate? Because lending requires capital, real money. Carbon used a combination: equity funding, debt financing, reinvested revenue. This allowed them to fund loans and grow their lending capacity. Now here is something important. Lending startups don't just raise money, they deploy money. And that makes the model different. Now let's move to traction. Early growth. As users started taking loans, repaying, and returning, the system began to prove itself. This created trust. And trust drives growth in financial services. Now let's move to funding. Raising capital. Carbon attracted investors because of a large underserved market, a working digital model, strong user demand. But here is the key. Investors were not just funding the company. They were funding the loan book. Now let's talk about something deeper. Why investors believed in Carbon? Because they saw high demand for credit, a scalable digital platform, strong revenue potential, growing user base. This made the opportunity attractive. Now let's move to scaling, expanding services. Carbon didn't stop at loans. They added payments, savings, bill payments. This increased user engagement. Now here is something important. The more value you provide, the more users stay. Now let's move to another key factor: user experience. Carbon focused on simplicity, fast approvals, easy interface, minimal friction, because convenience drives adoption. Now let's go deeper, because this is where many founders fail. Risk management. Lending is risky. If users don't repay, losses increase. So Carbon had to build strong systems. Credit scoring, data analysis, fraud detection. Now, let's move to something critical: unit economics. Each loan must be profitable. Interest must cover defaults, operational costs, funding costs. Because if the numbers don't work, business fails. Now, let's step back and look at the bigger picture. Carbon's success came from solving a real problem, using technology for lending, securing funding for loans, managing risk effectively, expanding services. Now, let's come to the important insight I mentioned earlier. Something that can completely change how you think about startups. Carbon didn't just build an app, they built a financial engine. Let that sink in, because behind every simple interface, there is a complex system, and that system creates value. Now, here's the final truth. If you are building a startup today, don't just think about the product. Think about the model. Think about how money flows. Think about how value is created. Because when you understand that, you don't just build a startup, you build a business that can scale. Just like Carbon. Rocket. Welcome to Cenedesk, your guide to learning tech, building real skills, and starting your career the smart way. Hit subscribe and join thousands of learners growing every day.